Good afternoon and welcome to today's webcast, Lease Accounting Changes for Tribal Entities. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from West Adams Tribal and Gaming Practice, John Greear, Partner, and Mark Siadal, Senior Manager. And with that, I'll turn it over to Don to get us started.
Thanks, Emily. Also joining Mark and I in the room today is Tasha Rep, the National Practice Leader for our Tribal Services Group. Tasha will be monitoring the questions you submit online throughout the call and may also provide commentary at certain points of the presentation. Tasha, thanks for joining us today. So with that, I'll turn it over to Mark.
So today we plan to cover the GASB lease standard in the following 5 sections. First, we will cover the scope, terms, and overview of the standard. Then we will touch on the timing of implementation. We will discuss how you can prepare for the standard and provide certain implementation considerations. We will give our perspective on the standard and what you should expect during your audit. And finally, we will try to leave time at the end for questions that you might have. And with that, Emily, that brings us to our first polling question.
All right, our first polling question today. How prepared do you feel to implement GASB 87? And your options are A, I'm early adopting. B, I've read the standard and feel prepared, but I don't plan to early adopt. C, I've started preparing but have a lot more to do. Or D, this webinar is my first step towards preparing to implement GASB 87. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit Submit. A few more seconds here. And let's go ahead and take a look at the results. Back to you.
So it looks like we have a lot of work to do.
Yeah, looks like a lot of work to do, and this might be your first steps towards preparing for the webinar, or for 87.
So I'll start off by just covering the scope and terms of the standard, provide a general overview, the overall objective of GASB 87 was to establish a single model for lease accounting based on the foundational principle that leases are financings of the right to use an underlying asset. Consequently, a lease is recognized to recognize a lease liability and an intangible right to use asset, and a lessor is required to recognize a lease receivable and a deferred inflow of resources. The underlying assumption of the new guidance is that leases are financings. We'll have a table later on that more clearly shows the nature of the resulting assets and liabilities. The first paragraph here outlines the lease definition as outlined in the standard. And what it says is that a lease is a contract that conveys control of the right to use another entity's non-financial asset as specified in the contract for a period of time in an exchange or exchange-like transaction. I'd like to focus on a few specific elements of this definition. First, note that the old capital lease and operating lease terminology is going away. Second, the concept of control will be important in certain situations. In the second paragraph, we include that definition, and control of the right means 1, it's the right to obtain the present service capacity from use of the underlying asset as specified in the contract, and 2, the right to determine the nature and manner of use of the underlying asset as specified in the contract. And item number 2 in that definition will likely be key when it comes to land leases in particular, including rights of way and easements. We'll discuss some examples in more detail later, but for now, the key takeaway is that the lessee must gain the right to determine the nature and manner of use of the underlying asset. With respect to the definition of the term non-financial asset, the standard simply states that examples of non-financial assets include land, buildings, vehicles, and equipment. So pretty straightforward, just be mostly capital assets. It's important to note that even if a contract or agreement isn't specifically labeled as a, quote, lease in its content, if it meets the definition, it would be covered by this standard. We also include a note here at the bottom, which we'll expand on more later, about short-term leases. But if a lease has a maximum term of 12 months or less, it will be expensed. Understanding the lease term is going to be a critical implementation issue for most. Per the standard, periods for which both the lessee and the lessor have an option to terminate the lease without permission from the other party, those are cancelable periods and are excluded from the lease term. Or, if both parties have to explicitly agree to renew or extend the lease, the renewal or extension period would be excluded from the lease term. For example, a rolling month-to-month lease or a lease that continues into a holdover period until a new lease contract is signed would not be enforceable if both the lessee and the lessor have an option to terminate, and therefore either party could cancel at any time. With respect to termination options, provisions that allow for the termination of a lease due to 1, purchase of the underlying asset, 2, payment of all sums due, or 3, default on payments are not necessarily considered termination options as defined in the standard. And as you read through the bullets here of what's included in the lease term, you'll see this term reasonable certainty quite a bit. So we're going to talk about that a little bit because judgments about what is reasonably certain could greatly impact the lease term. The standard suggests that at the commencement of the lease term, the lessee and the lessor should assess all factors relevant to the likelihood that the lessee or the lessor will exercise their options, whether these factors are contract-based, underlying asset-based, market-based, or government-specific. The assessment often will require the consideration of a combination of these factors. And in the standard, they suggest 4 different factors to consider. These aren't meant to be all-inclusive, but they include, number 1, you would want to consider any significant economic incentives, such as contractual terms and conditions for the optional periods that are favorable compared to current market rates. Put simply, if you get a better rate upon renewal, that increases the likelihood you would exercise a renewal option. The second thing to consider would be a significant economic disincentive, such as cost to terminate the lease and sign a new lease. For example, if you're going to incur negotiation costs, relocation costs, or substantial cancellation penalties, that's going to increase the likelihood that you might not want to renew. Third factor to consider is your entity's history of exercising options in the past. if you have a long history of extending or exercising options to renew, it's going to be a little bit harder to claim that you don't plan to in the future. And number 4, the extent to which the asset underlying the lease is essential to providing government services is going to be important. I mean, clearly if an asset is critical to providing an ongoing service for a program, that would increase the likelihood of exercising an extension option. Down at the bottom of the slide, we talk about how the assessment should be made at the beginning of the lease term and only needs to be updated if an option is exercised or an option is not exercised that was not initially expected. So if something changes in a significant way from what was expected, you might need to revisit this. As we were preparing the slides, an example we thought of with respect to lease term determination that could have implications for tribes relates to tribal land leases, say to discrete component units. These land leases sometimes have long terms with options to extend. Because of the long terms and the reasonable certainty that a lease would be renewed, the lease term could be long. For example, let's say a tribe leases land to a tribal convenience store for an initial period of 10 years, with an option to renew for another 10 years after that. In this example, absent a formal tribal plan that would change the future use of the land 10 years from now, it would probably be assumed that the renewal option would be exercised, making the total lease term 20 years. So even if the monthly lease charges aren't significant or material currently, over time, the net present value of those payments could represent a potentially significant lease asset for the tribe in the form of a lease receivable and or a significant lease liability for the component unit. A couple of clients have already called with questions about whether, to learn more about short-term leases and what qualifies as a month-to-month. Assuming that the month-to-month lease is contractually cancelable by both parties, it could be considered a short-term lease. If that is the case, then you would expense as incurred. I want to pause on this for a minute. You know, we have a number of casino clients that have focused on this month-to-month or this short-term lease exception as a possible opportunity to scope their gaming machine agreements out of the standard. They're effectively hoping or assuming that their agreements are cancelable at any time and therefore can continue to be expensed as incurred as they have in the past. Additionally, some gaming machine department managers will say that from a practical standpoint, they can get out of a gaming machine lease at any time. However, based on a review of many of our client agreements, we're not sure that's going to work in many cases. You have to review the underlying agreements themselves to ensure the provisions A, do indeed permit the ability to cancel at any time, and B, both parties must have that cancellation right. During review of several client agreements, several were silent as to the vendor's ability to cancel at any time in particular, which makes sense given the nature of the contracts. But it's definitely something that you'll have to look at. Another potential issue for gaming machine agreements, and possibly other long-term lease agreements that you have in other government programs, is that many of them may be subject to old master agreements, for which a number of addendums or amendments have been made over the years. You'll need to consider the terms of all the related applicable agreements when evaluating lease terms, not just the most recent addendum or amendment.
So the standard will apply to many of the leases you have, but there are certain leases that the standard does not apply to that are listed on this slide. We have highlighted in bold a few items that might be of specific interest to tribal governments and their enterprises, which we'll discuss on the following slides. Those include leases of intangible assets, biological assets, and leases based on future performance. So the first item we want to go into a little more detail about are intangible assets, and some of the things you'll need to consider if you have these types of leases. So if you have leases related to natural resources, a lease for the right to exploit natural resources is an exclusion from the standard. But note that if you're leasing the right to use the land to a company who would then exploit natural resources, this would not be scoped out since you are leasing the land specifically and not the intangible right. This is an example where you're really going to need to understand the terms of the lease agreement to know what is exactly actually being leased and to reach a proper conclusion about whether the standard will apply or not. Another example of an intangible asset that we see in certain jurisdictions relates to gaming rights, to include the right to use an allotment of slot machines. So, for example, in Washington State, each tribe is allotted a maximum number of gaming machine use rights. Washington State tribes without casinos or that own smaller casinos can transfer some or all of the gaming machine terminal rights to other tribes for a fee. These agreements would not fall under the lease definition of GASB 87, as the purchaser is obtaining the right to use an allotment instead of the underlying physical asset. That purchaser still needs to go out and acquire the physical gaming machines themselves. A third example has to do with software and maintenance fees associated with gaming machine agreements. The portion of any gaming machine agreement that specifically relates to the software and maintenance fees would be excluded from this standard. With respect to contracts with multiple components, such as a gaming machine agreement that includes fees for the use of the gaming machine terminal itself, software, and/or maintenance, the lease standard requires that each component be accounted for as separate contracts. So some of the costs might be subject to the lease standard, while other costs may be expensed as incurred. If the price breakout for each component is unclear or cannot be determined, or if the prices for individual components appear unreasonable, the standard suggests using professional judgment. If it isn't practical to do a reasonable estimate, then everything should be accounted for as a single lease unit, and the accounting would be based on the primary lease component. So, for example, if the primary purpose of a gaming machine lease is actually getting the physical gaming machine terminal on the floor, which is probably the case most of the time, then you would account for everything as if it was a capital acquisition. Leases of biological assets are specifically excluded from the standard as well, but there are things you will need to consider. Just for example, if a tribe owns land and it leases that land to another entity for use as cropland, then the requirement of Statement 87 will still apply. Although the use of the land for farming may produce biological assets, the underlying asset of the lease is the land, which is not a biological asset. Therefore, this lease would not be excluded from the scope of Statement 87. Grazing and hunting rights must also be closely evaluated, as would easements. So remember that for an agreement to be defined as a lease, the lessee has to obtain the right to determine the nature and manner of use of the underlying asset. So for example, if a rancher obtains just grazing rights from a tribe, but that tribe requires the rancher to permit other recreational activities on the land, or the government has the right to construct roads, buildings, or otherwise alter the land without permission of the rancher, then the rancher was not conveyed the right to determine the nature and manner of use of the land. So this would not be a lease under the standard. The circumstances of each of these types of leases agreements must be evaluated individually. Again, it is going to be very important to really understand the nature and terms of your agreements to know whether you have a lease of an underlying asset and how it should be reported. So the final item we want to touch on for items that are scoped out of the standard has to do with leases that are based on future performance. One example would be a revenue sharing or participation agreement for gaming machines, whereby a casino obtains gaming machines and pays the vendor a fee based on a percentage of revenue. If such an agreement is strictly a revenue sharing agreement, then it would be expensed as incurred. However, it's important to note that if the arrangement includes a fixed component, such as a base minimum charge per day, then that fixed component should be considered and measured as a lease liability. The difference between the fixed component and the actual amount you pay each year based on performance would then be expensed as incurred. Another example from a lessor standpoint might be for a franchisee of, say, a McDonald's to lease a building from the tribe or space in a casino's food court. If the tribe or casino receives only a percentage of future sales, then the lease would be excluded from the standard. But again, you're going to need to review those types of agreements to ensure there are no minimum payments required to be made, which then the standard would apply to. So to get into the accounting a little bit, as noted earlier, at the commencement of the lease term, a lessee will need to recognize a lease liability and an intangible right to use lease asset. The lessor will recognize a lease receivable and a deferred inflow of resources. In addition, the lessor will continue to report the leased asset on their books as well. So that means a lessor will have two recorded assets for the same asset. One, a lease receivable, and two, the underlying capital asset being leased. And we'll go over the accounting for these in more detail on the following slides. So for lessee accounting, the value of the initial liability recorded by the lessee is going to be equal to the present value of the payments expected to be made during the lease term. This should include fixed payments, variable payments that depend on an index rate, and the exercise purchase price of an option that is reasonably certain of being exercised, among other items listed in the standard. As we mentioned earlier, for gaming machines, many are based on a percentage of net win, but some also have guaranteed minimums that would have to be incorporated into the potential lease liability calculation. We also note that some of these percentage agreements have maximums in the agreement, but the maximums don't get factored in and would be considered part of the variable option. So then, all these payments should then be discounted using the interest rate the lessor charges the lessee, which should be the interest rate implicit in the lease. If the interest rate cannot be readily determined by the lessee's estimated incremental borrowing rate could be used. So then, when these lease payments are made throughout the term of the lease, you're going to amortize the discount on the lease liability to interest expense, with the balance reducing the lease liability. We're not going to go into the remeasurement considerations in detail, but be aware that there are several triggering events that require remeasurement of the lease liability. Those include when there is a change in the lease term, if an assessment of all other factors indicates that the likelihood of a purchase option being exercised has changed from reasonably certain to not reasonably certain, or vice versa. There's a change in the estimated amounts for payments already included in the measurement of the lease liability, or there's a change in the interest rate the lessor charges the lessee, if that was used as the initial discount rate. Please note, though, if the discount rate does not need to be reassessed solely for a change in a lessee's incremental borrowing rate, if that was what was used in the initial valuation. So then the lease asset that you're going to record, the value of the asset recorded will be the initial value of the lease liability that we calculated on the previous slide, plus any prepayments that have been made, any direct costs that are associated with that are necessary to place the asset in service. The lease asset should then be amortized over the shorter of the lease term or the useful life of the underlying asset. And this amortization can be combined with depreciation expense related to other capital assets on the income statement. So then some of the lessee disclosures that you're going to see in your footnotes, they should include descriptions of the leasing arrangements. As discussed earlier, Lease agreements come in different forms, whether revenue share or fixed payments, and or might have multiple components. So you may need to track and disclose those separately. For example, depending on the leases you have in place, you should disclose leases subject to the lease standard under fixed payment contracts, and leases subject to the lease standard but not accounted for as a liability because the payments are variable, as would be the case for rev share agreements. And then these lease assets are going to be considered capital assets and should be disclosed in the roll forward of capital assets. However, you're going to want to have its own separate line within that capital asset roll forward. You're also going to have to disclose the nature and extent of any related party leases. You're going to be required to disclose future payments for each of the next 5 years and in 5-year increments thereafter. So this is going to be really similar to what you currently see in your long-term debt footnotes. And then finally, just note, there is no disclosure for short-term leases. Those are the leases that are less than 1 year or cancelable by either party, but please note that those still will need to be tracked internally.
Okay, on the lessor side, they'll be recording a lessor receivable, and that's equal to the present value of fixed payments, variable payments that are based on an index or a rate, variable payments that are fixed in substance, residual value guarantees that are fixed in substance, or lease incentives due to the lessee. The payments should be discounted using the interest rate the lessor charges the lessee, which may be the interest rate implicit in the lease. We're not going to go into the details of how to calculate the implicit rate, but GASB does provide guidance on that, so you can look that up. And just as for lessees, certain triggering events may require remeasurement for lessors. So beware of the following 3 situations that might trigger remeasurement for the lessor. First, there's a change in the lease term. Second, there's a change in the interest rate the lessor charges the lessee. Or 3, sometimes leases will include variable payments that, subject to certain contingent events, become fixed payments. If these contingencies are triggered, that would require remeasurement because now those payments that were variable before are now fixed. As receipts come in, the lessor should amortize the discount to interest revenue, with the balance reducing the lease receivable. The lessor's deferred inflow should be recorded as revenue over the term of the lease. Lessor disclosures will include a description of leasing arrangements, including the basis on which variable payments excluded from the lease receivable are determined. So it's kind of important to highlight here as we go through these bullets in a few spots. It's not just what got recorded as lease receivable, it's also some of the stuff that was variable that isn't recorded in the lease receivable. Some of that's required to be disclosed as well, subject to materiality, of course. Total inflows of resources, with revenues including interest, recognized in the reporting period from leases and from variable payments that were excluded from the original lease receivable. You're going to disclose the terms of lessee cancellation options, payment secured debt of the lessor. There are a number of other applicable transactions relating to subleases and others that you'll want to consider in the standard. Of course, disclose, just as with the lessees, the nature and extent of related party leases. And if the principal operations are leasing, which might be the case for certain tribal enterprises, you'll need to disclose the future principal and interest payments for the 5 years and in 5-year increments thereafter. All right, Emily, that brings us up to our second polling question.
Great, thank you. And the question is, with regard to the new disclosures required by GASB 87, they will A, increase the length of my entity's notes to the financial statements by at least a few pages. B, won't significantly increase the length of the disclosures but may change the content. Or C, I do not yet have enough information to be able to predict the impact on my notes. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. A couple more seconds here. And let's go ahead and take a look at the results. Back to you.
All right. Those answers are kind of what we expected. I do think it'll probably have more significant disclosures in most cases than you would think. Obviously, it also depends on the level of your lease activity.
So next, we're going to go over the timing of this standard. The requirements of this standard are effective for reporting periods beginning after December 15th, 2019, which will be the calendar year ended December 31st, 2020, or fiscal years ended June 30, 21, or September 30, 21. Note that adoption is retroactive to all periods presented, so it is important to start analyzing your agreements now in order to ascertain what the amounts are for 2019 for the calendar reporters and 2020 for June and September year ends. So leases should be recognized and measured using the facts and circumstances that exist at the beginning of the period of implementation, or if applied to earlier periods, the beginning of the earliest period restated. Please note that you do not restate the assets underlying existing sales type or direct financing leases. Any residual assets for those leases become the new carrying value. And also note that there's additional transition guidance in the standard as well, beyond just these items. The next few slides, we will cover how you can prepare for the standard and some implementation considerations. As you prepare for the standard, the first place to start would be the statement itself, which was issued in June 2017 and is available at GASB.org. The implementation guide was just published earlier this month and is also available at the GASB website. Many of our examples earlier in the presentation, such as the examples relating to croplands and grazing lands, are addressed in the implementation guide. There are other potentially useful questions and answers in the guide to include guidance on easements and cell towers, among others. The implementation guide also includes a non-authoritative appendix with illustrations. In addition, there have been numerous articles published by CPAs and other third parties on this standard. And finally, you can always call your CPA with any questions that you have. So, how can you prepare for the standard? Start the process now. We can't emphasize this enough. Even if you're a smaller tribe or casino, the implications could still be significant. And here's just a few examples for some casinos we looked at. For example, one, we looked at all the gaming machine leases for one of our smaller casinos, thinking that it might be a simple implementation for them. And we found that they had 12 agreements to review, just for gaming machines. Many had an initial term of 12 months and then converted to month-to-month. But one had an initial lease term of 18 months before it changed to month-to-month. And one was a one-year lease with annual extensions, but did not convert to month-to-month. Also, several of the agreements were based on a percentage of net win, but 3 of the agreements had guaranteed minimums, which would apply.
We also took a look at a recent Class 2 gaming machine lease that was signed by a client just this last few weeks. It was for 30 machines, and it had an initial fixed 24-month term with an option to renew month-to-month after that. After 24 months, either party could cancel the month-to-month term. So for the lease term, we believe this would be a lease as the non-cancelable term of 24 months does exceed 1 year. And since the month-to-month term is cancelable by both parties at any time, the preliminary conclusion is the lease liability would have a term of 24 months. On top of that, the agreement called for certain of the 30 machines to be straight revenue share agreements, while the other machines would be a fixed charge. However, The agreement did not specify how many of the 30 machines were revenue share versus fixed charge. So measuring the liability will require more work by the client because they'll need to evaluate specifically how many of the machines would be subject to revenue share and therefore expensed versus how many would be subject to fixed charges and therefore recorded as a lease liability. Another challenge to recording the lease liability is that the agreement does not specify an interest rate. This is very common in gaming machine agreements, so the client will have to evaluate the implicit rate or use their incremental borrowing rate. Lastly, they'll need to evaluate whether the resulting fixed charge lease liability would be material. So even with just one agreement for 30 machines, there's a lot of factors there impacting the lease term, how you calculate the interest rate, and so on. So the overlying lesson here is that it's really important to understand the standard, read through your lease agreements, and start documenting your assessments now. This will be a time-consuming process for most of you. If you wait until the audit starts and/or expect the auditor to assist you significantly with these assessments and the underlying journal entries, it may result in additional auditor fees. We're not suggesting you don't use your CPA as a resource. In fact, we highly recommend you do consult your CPA. We just want to stress that this isn't a situation where the implementation can be knocked out in a few hours during the annual audit cycle.
Yeah, so, you really should be gathering all executed lease documents currently in effect, including any amendments. Gather other contracts that convey a right to use an underlying asset, and then start identifying the key provisions in your lease documents. The lease terms, extension or termination provisions, payment provisions, implied interest rates, and kind of get all that information summarized in one place. And finally, you're really going to need to bridge the gap, which I mean here is make sure you're talking to individuals in different departments to make sure that accounting, one, has all the agreements that are currently in place, and also make sure they're going to get copies of all new agreements in the future.
On this slide, we listed off a number of potential lease situations you'll need to look out for. First off is intra-entity agreements. The best example here would be like the land leases between tribes and component units like we talked about earlier. You'll also want to make sure you've got a handle on any vehicle or fleet agreements with third parties to acquire the use of vehicles for programs or other activities. Consider your IT agreements for equipment and servers, etc. We anticipate at this time that most of those would not fall under the lease standard, but as you perform an inventory of potential lease agreements, make sure IT agreements are included in your analysis because there might be some stuff there that falls under the standard. To the extent the tribe or its enterprises to include in casinos leases storage units for use, those would be something to look at. A few casino-specific items relate to ATMs, kiosks, shuffle machines, etc., some of which you may just buy outright, but for those that you pay monthly fees for, you want to look at those agreements. From the lessor standpoint, we're going to look at leases of land or buildings to tribal members, leases of land, buildings, or equipment to outside parties in general. On the casino side, this is pretty common nowadays and increasingly common to see casinos lease out space to third parties for retail operations or for food and beverage operations. So those would also need to be looked at. And I've seen a variety of those so far, and those can get fairly complex in terms of figuring out how much of those lease agreements are fixed payments or variable or a combination of both. Mark touched on this a little while ago, but we want to include a slide about agreements that have multiple components. If an agreement covers a variety of includes a number of components, you'll need to evaluate each of those individually to see how the accounting should go. And as an example, I'll talk about the Class 2 gaming machine agreement I talked about a couple slides ago. Another element of that contract that I didn't cover earlier was that the machine fees covered the physical gaming machine, all the software, and all the maintenance. But the cost of each of those components was not allocated out, and management is uncertain to the market value breakout of each service. In accordance with the guidance, absent a reasonable allocation method, you would follow the primary purpose of the contract, which in this case management believes is the use of the physical machines themselves. So in that example, the entire lease fee would be treated as a lease liability, and none of the costs would be scoped out as discussed earlier in the presentation. In other words, rather than be able to expense the software or maintenance portion, all of the expense would be treated as part of the lease. So again, the takeaway here is to read those agreements closely to see what tangible evidence they have of the breakout. If they don't, or they're silent, or it's unclear, you're going to need to use estimates and judgment. With respect to intra-entity leases, if there are leases with blended component units, elimination should take place for internal leasing activity before financial statements are aggregated. And along those lines, with respect to the blended component units, although eliminations would occur in general purpose financial statements, keep in mind that leases should be disclosed in standalone component unit financial statements if such standalone statements are issued. If there are leases with discretely presented component units, you treat like a normal lease, but present the receivables and payables as separate line items on the financial statements. A few best practice items when you're implementing. Make sure that whatever tools you use to inventory and measure lease activity, whether it be Excel or some other software, is functioning accurately and that user access is appropriately monitored and controlled. Internal controls should be developed to ensure that the lease accounting tools are updated timely and that safeguards are in place to protect the accuracy of any formulas used, particularly in Excel, which is prone to user error. The third bullet down here we bolded because we think it's a significant one. You're going to want to identify and consider the potential impacts on financial covenants and calculate the ratios based on implementation of GASB 87 for debt agreements to determine whether you're still in compliance. This is going to be especially important for casinos, and I feel like we've talked a lot about casinos, but we think there's a lot that's going to impact casinos here. Most casino debt agreements include financial covenants requiring the maintenance of certain leverage and fixed charge ratios, which are in turn driven by the casino's long-term debt balances and EBITDA. For example, if a casino determines some of its gaming machine agreements qualify for lease accounting under the new standard, both long-term liabilities and EBITDA would be impacted. Long-term liabilities would increase, and EBITDA would increase as well because lease expenses that had previously been classified as operating expenses would instead now be charged to amortization and interest expense. So rather than be a deduction to calculate EBITDA, they would be an add-back. Additionally, because many casino debt agreements bear interest at adjustable rates that periodically reset depending on the casino's leverage ratio, the underlying debt pricing could be impacted as well. And lastly, debt agreements frequently include limitations on additional indebtedness. So any new long-term liabilities relating to leases could draw the attention of lenders. So, to help lessen any potential negative impacts, casinos will want to communicate with lenders to ensure both parties understand how the new lease accounting standard may affect their financial covenants and interest rates. Going on down the slide here and moving on from debt covenants, you're going to want to consider whether there are other changes to internal controls that will be necessary, and we'll talk about that again here in a moment. Consider the advantages of IT. We are proponents of saving lease documents as searchable PDF files and using the Adobe bookmark function just to get the basic terms flagged. Require that all lease documents be scanned and indexed in one central repository so that everybody can get at them. And utilize any existing debt management software to automatically generate amortization schedules and help to create journal entries. We've had a few questions about whether you could adopt a threshold for assessing leases similar to the capitalization threshold used for capital assets. GASB doesn't address this, and as with all standards, the standard doesn't apply to immaterial items. So we do think that establishing a threshold is not an unreasonable approach. Keep in mind that the threshold may be different than capital assets, as different criteria may be used to determine whether the lease results in a significant liability. For example, if you have a debt covenant that limits your ability to enter into additional indebtedness, the bank might not care whether it's a small or a big lease. So you're going to need the materiality factors could be small. It just depends. And on the last bullet here, we're highlighting the fact that many clients have capitalization policies that call for capitalization of certain bulk purchases that although individually below capitalization thresholds, are significant in the aggregate. For example, a casino resort may buy 100 televisions for hotel rooms and capitalize those in total, even though individually the TVs are well below the capitalization threshold. You may want to take a similar approach to potential lease liabilities and consider a policy that takes into account large aggregate acquisitions. Emily, that takes us to the next polling question.
All right, our third question. How do you plan to prepare for GASB 87? A, I'm not going to wait. I'm going to start as soon as this webcast ends. B, looking at increasing the communication between departments to ensure all leases that are currently in effect are identified and accounted for properly. C, identify the individuals that will be responsible for implementing GASB 87 and ensure appropriate segregation of duties and establishment of internal controls. Or D, all of the above. And for those of you that would like a copy of today's slide deck, you can download them now from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. I'll give everyone a couple more seconds here. And let's go ahead and take a look at the results. Back to you.
All right, thanks, Emily. Right. All of the above. Good idea. All right, so our last section here is just a few thoughts from us as auditors about what to expect. You know, when we complete an audit, we use the analogy of filling a bucket with respect to gaining assurance, as in, how will we gain sufficient assurance that transactions are properly accounted for and disclosed? And to fill our bucket for the audit, we will use a combination of three testing methods. We'll test internal controls, we'll perform analytical procedures, and we'll do tests of transactions individually. This slide is focusing on the first with respect to internal controls, because we think there's going to be a lot of changes there with respect to the amount of questions you might get from auditors in that area. Auditors will need to understand what processes have changed within the organization to implement the standard. We may ask questions about whether new policies and procedures need to be drafted or whether they have been drafted, or do they just need to be amended. For example, there will no longer be 4 criteria to evaluate in determining whether a lease is an operating lease versus a capital lease. So if your existing policies include that old terminology, there'll need to be some changes. Another example would be whether you have tickler files or other ways to track when a lease term ends and you need to reevaluate your schedules for appropriate recording. Although operationally the lease environment hasn't changed, you may see more focus and questions from the auditor surrounding how a lease agreement gets entered into. Are there segregation of duties between those that approve leases, record transactions, and handle assets? One thing we see with significant long-term debt agreements at tribes is that usually there are internal controls to ensure that the appropriate people are negotiating the underlying debt agreements. If your tribe requires council or board approval for entering into long-term debt agreements, you may want to think about if any lease agreements now fall into that category, or at least establish a threshold at which council or board approval might be required for lease agreements. The fourth bullet down here is communication, and I think there will definitely be a focus on that. This is where we see a big potential for implementation gaps. And Mark talked about this a little bit earlier, but if the legal department or executive management or department manager, say like a gaming machine department manager at a casino, if those are the people that are setting terms or entering into leases, we need to make sure they know the importance of communicating with their finance team as well. The finance department will need to be involved to assess the financial impacts of new leases, to include consideration of the impacts another long-term liability may have on the financial statements and the relevant debt covenants. With respect to monitoring, are there monitoring controls in place to appropriately review and record these assets? Sometimes, due to the complexity of certain agreements, this may require more involvement by upper finance or finance personnel to ensure that there are another set of eyes involved in reviewing the schedules and calculations. Many organizations will set up recurring journal entries to record amortization and discounting. The auditors may want to perform additional analysis of the IT systems used to maintain that data and record such recurring transactions. And finally, this last bullet here we think is really important from an auditor perspective, and that has to do with documentation of your evaluations and conclusions. It's important that schedules developed by management include all the important terms and accounting judgments made, even if they don't impact the liability or if they don't create a lease liability. For example, if prior to the audit, the finance department has already concluded that variable payment is performance-based rather than fixed, and therefore is excluded from lease liabilities, internal documentation helps auditors gain comfort that management has done a thorough and accurate assessment of the terms. Even if a lease is not determined to be scoped in from a liabilities perspective, the audit firm will need to get comfort over footnote disclosures, which sometimes include payment, as we found out earlier, will require some disclosure of variable payments. Finally, recall that especially with respect to determining the lease term, you will need to use judgment to assess whether it is reasonably certain that renewal and termination options will be exercised. You'll want to discuss and document your judgments and conclusions with respect to reasonable certainty so that the auditor is able to gain comfort with your conclusions. Before we leave this slide, I just want to go back to the communication topic as it relates specifically to tribes. And this is both in the casino front and the tribal and enterprise. On casinos, gaming machine arrangements have often historically been negotiated by gaming machine department personnel, sometimes with little or no involvement from accounting personnel. That's not true at all casinos, but it's common at many. Management may want to implement policies and procedures that help ensure all parties communicate about potential lease agreements before they're finalized to mitigate unwanted or unfavorable accounting consequences. And if management is seeking a specific accounting outcome, then it will be essential to get the lease terms drafted up front appropriately. This communication issue may exist for tribal governments as well, where department or program managers may negotiate leases with little or no input from finance. So something to think about as you start to look forward on new policies.
Yeah, and so this slide, these are just some additional presentation and disclosure items to think about. As we mentioned, you're going to need to restate prior periods and disclose the impact on prior years. You will need to make a decision to present 1 versus 2 years in the financial statements, as that will impact the work you do. Now, in many situations, you might not have a choice, or the decision might be simple. Tribal government financial statements are typically not comparative, while casinos are required to present comparative financial statements per NIGC regulation. But there may be some choices for other tribal enterprises that may be reported on a standalone basis. So make sure you discuss these options with your CPA as well. There's going to be new general ledger accounts to record lease assets, lease liabilities, and deferred inflows. And it'll take some time to map those accounts to the financial statements, so plan accordingly for that. Cash flow statements are going to have to show lease payments and cash receipts, so make sure those are being tracked and summarized. Your revenue recognition policies will most likely need to address policies related to lease income and when it is recognized. Also, you're not going to want to have a page footnote disclosure for every single lease. So to the extent you can, you'll really need to group leases with similar terms for consolidated disclosure. And then, finally, the MD&A will have to talk about your leases in the long-term liability and capital asset section.
All right, Emily, last polling question.
All right, our final polling question. As you look towards implementation, what do you believe will be the most important item for your organization to review? And your options are A, internal control policies and procedures, B, the impacts on debt limitations, bond covenants, and grant agreements, C, the mechanics of how leases will be tracked by my organization, or D, all of the above. And once you have completed all CPE requirements today, you will be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. Give everyone a couple more seconds. All right, let's go ahead and take a look at the results. And with this, we do have some time left for questions. If you have Questions for Dawn, Mark, or Tasha, you can enter those now in the Q&A box under the slide view. I'll see what we've got here. We have had a few questions come in. Let's go with, if I am a calendar year end and I have to restate my 2019 financial statements at the end of 2020, do I just need to calculate what the lease liability and lease assets are at December 31st, 2019?
I'll take that one. So actually the answer to that would be no. You will actually need to know the lease liability and lease asset values as of January 1st, 2019, and you will need to restate operating expenses during 2019 that are related to lease payments made in 2019, because you'll have to move those to amortization and interest expense. This is one of the reasons it's so important to start the process now and review leases in place now, as we're almost 9 months into 2019 already.
All right, let's see what else we have here. Our tribe leases land to each of our enterprises for $1 a year. Does this need to be accounted for as a lease?
No. The lease standard should only be applied to exchange or exchange-like transactions. So since the value of the land being leased is worth presumably more than $1, the standard would not apply in that situation.
Thank you. We have time for at least one more here. If a gaming machine agreement allows the casino to cancel at any time, but the agreement is unclear or silent about whether the vendor can cancel at any time, can this be considered a short-term lease?
No. As talked about earlier, the agreement has to be contractually canceled by both parties. I don't know if you have, so I would say the answer to that is no.
All right. That is just about all we have time for questions. If you had questions that we did not get to answer today, we will do our best to follow up with you after the webcast. And you can continue to ask questions under the slide deck, under the slide window in the Q&A box. And thank you, Mark and Don, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.